A summary of Reading 26, Alternative Investments Portfolio Management. Source, CFAI textbook. Alternative investments have become a significant portion of the portfolios of both individual and institutional investors. The reading presented 6 groups of alternative investments: real estate, private equity, commodities, hedge funds, managed futures, and distressed securities. Common features of all alternative investments include relative illiquidity, which demands a return premium as compensation, diversifying potential relative to a portfolio of stocks and bonds, high due diligence costs, and the difficulty of performance evaluation. Due diligence for alternative investment selection should cover market opportunity, investment process, organization, people, terms, structure, service providers, documents, and write-up. Special concerns for advisors to private wealth clients include tax issues, suitability, communication with the client, decision risk, which is the risk of changing strategies at the point of maximum loss, and potentially concentrated equity positions of the client in a closely held company. The physical real estate market is characterized by a relative lack of liquidity, large lot size, high transaction costs. Real estate investment can be divided into terms of direct ownership and indirect ownership. Direct ownership includes investment in residence, business, real estate, agricultural land. Indirect ownership includes investment in vehicles such as REITs. Advantages to real estate include tax benefits, the use of leverage, control over property, diversification, potential as an inflation hedge, and low volatility of returns. Disadvantages to real estate include the inability to subdivide real estate investments, high information costs, high commissions, maintenance and operating costs, location risk, political risk related to tax deductions. Private equity investments are highly liquid, and investors must be willing to hold these securities for long periods of time. Private equity investments include startup companies, middle market companies, private investment in public equities, also known as PIPEs. Private equity investors include angel investors, venture capitalists, and larger companies in the same industry. There are 2 broad approaches to investing in commodities: direct and indirect investments. Direct commodity investments entails purchasing the physical commodity or using derivatives with direct exposure to the change in prices of spot. In contrast, indirect investment in commodities involves the acquisition of indirect claims on the commodities. Inflation hedging ability of commodity investing appears to vary according to the commodity. Hedge funds. Hedge funds are skill-based investment strategies in various forms, including the limited partnerships. The funds use various investment strategies and thus are often classified according to investment style. Within each strategy, hedge funds are classified according to the underlying market or the unique trading style. For example, relative value, event-driven, hedged equity, and global macro. Within each style classification, there's a number of subgroups. For instance, within the hedge fund relative value style classification, subgroups include market neutral long, short, convertible hedging, and fixed income arbitrage or bond hedging. Hedge funds can both provide return and diversification benefits, but the risks are not usually well represented by standard deviation. Managed futures are actively managed investment vehicles that have many of the features of hedge funds, like their compensation agreements. However, managed futures programs primarily trade futures and options contracts, whereas hedge funds are more active in the cash markets. Managed future programs include systematic trading strategies based on trading rules applied to price data and often are managed and traded by computers. And also, the other option is discretionary trading strategies, which incorporate manager judgment and the fundamental data considerations. Distressed securities are securities of companies that are in financial distress or near bankruptcy. These securities can be equity, debt, trade claims, or other claims. Distressed securities investment exploits the fact that many investors are unable to hold below investment grade securities. Furthermore, few analysts cover the distressed securities market. The risks of distressed securities include event risk, J-factor risk or judge factor risk, liquidity risk, market risk, and other risks.